In this video, we're going to look at how your pension is taxed, but stay around until the end as we're going to look at some of the biggest mistakes I see people make when it comes to structuring their pension income from drawdown. I'll also give you a few examples to show you how pension's taxed that you can apply to your own circumstances. Starting with your pension tax-free cash, as you probably know, you can take typically up to 25% of an uncrystallised pension tax-free. This is known as a pension commencement lump sum, which is a mouthful. You don't have to take all of your tax-free cash at once. It's possible to take a series of smaller tax-free lump sums or even as a tax-free monthly income. Let's use the example of a £100,000 pension fund. When you come to take your tax-free cash, then you crystallise your pension, which can be quite complex and hard to understand when you first hear it. So if you haven't taken any income or tax-free cash from your pension, then your pension is known as uncrystallised. So if John takes all of the tax-free cash from within his pension, then he crystallises 100% of the pension fund. Using the 100k example, 25k will be paid to him tax-free, and the remaining funds would be still within the pension, but they'd be classed as crystallised funds. He'd be able to take these crystallised funds as income, but any income that he takes would be subject to income tax. So if you take all your tax-free cash, that makes sense. But what happens if you only take some of your 25% tax-free cash? Perhaps you don't need it all. Are you going to lose the rest? So let's use the same example with 100k, but John only takes, say, £10,000 of his tax-free money. So when John takes 10k tax-free cash, he crystallises £40,000 or 40% of his pension fund. £10,000 is paid to him tax-free, and the remaining 30k is designated within the pension as crystallised funds, which, again, to hammer home the point, he can still withdraw these whenever he wants or whenever he likes at a later date, but these funds will be subject to income tax at his marginal rate. 60% of his pension would still be uncrystallised, and he can take 25% of this amount tax-free in the future. Using the same example, but John leaves the remaining pension, say, for 8 years, and his pension's grown to maybe, let's call it 150k in that time. How much tax-free cash does he have then? Is it still going to be just 15k from the initial withdrawal? No, it's 60% of the pension still uncrystallised, which is 90k, and he can then take 25% of this amount tax-free, which equates to £22,500. The remaining, let's call it £67,000, moves to the crystallised side of his pension, which again, he can still take whenever he likes, and however he likes, but these withdrawals will be subject to income tax at his marginal rate. Okay, so know that once you've taken all your tax-free cash, then you will have crystallised your total pension fund. Once you take any crystallised funds, as we've said, these will be classed as taxable income. Does that mean that you automatically pay tax on the withdrawal, and if so, at what rate? Not necessarily. This is because it will depend on what other taxable income you may have, such as your state pension, final salary pensions, employment income if you're still working, and maybe if you've got rental income. Don't forget that the vast majority of people will have something called the personal allowance. This is where the first £12,570 of your taxable income is taxed at 0%. Assuming you've got no other income, if you take £12,570 of your crystallised pension, even though this is taxable income, as it is within the personal allowance, the effective tax rate will be 0%, so effectively tax-free. Let's assume then you've used all your personal allowance and you take a taxable withdrawal from your pension. How much tax are you going to pay? To answer this, we need to explore the various tax bands and tax rates. So we'll focus on people who live in England, Wales or Northern Ireland, and there are effectively 3 tax bands and rates that you can pay tax at: the basic rate, high rate, and finally the additional rate. Starting with the basic rate tax, the threshold is £50,270. This means any income above the personal allowance, but within this threshold amount, you're going to pay tax of 20%. Let's see how that works. So George, he's still working, as an employment income is conveniently £12,570, which takes up all of his personal allowance, which is taxed at, if you remember, 0%. He then takes 5k as a lump sum withdrawal from his crystallised pension fund, which, if you remember, this will be classed as taxable income. So what tax is he going to pay? Well, it's going to be basic rate tax, so the tax due will be £1,000. How about if your income pushes you over this threshold? Well, any income between £50,270 and £125,140 is taxed at 40%. Finally, if you have any income, if you're fortunate enough to take you above that additional rate threshold, well, the income will be taxed at 45%. So what happens if you straddle one or more tax bands? How does that work? So let's use an example. John, he's about to retire. His only income is going to be a state pension, which is the full amount. Call it 11.5k. In addition to that, he's got a private pension valued at over £1 million, which is fully crystallised as he went and blown the tax-free cash in a Lamborghini. He needs an extra £60,000 to meet his expenditure. So in total, his income is going to be £71,500 when we factor in the state pension. So what tax is he going to pay on this income? So he's got his full personal allowance remaining, so we need to deduct that from his gross income to arrive at that taxable amount of income. This means £58,930 of the income will be subject to tax. We take the basic rate threshold of £50,270 and deduct the personal allowance of £12,570 from this, which means £37,700 of the income is going to be taxed at 20%. So the basic rate tax due is £7,540. Well, what about the rest of the income that is above the basic rate threshold? So we take £71,500, that gross income, deduct the basic rate threshold of £50,270 from this, and so we're left with £21,230 that is going to be subject to income tax at 40%. So the high rate tax is going to be around £8,492. Therefore, the total tax payable will be a touch over £16,000 and his net income will be £55,468. This is an effective tax rate of 22%, despite, of course, him being a high rate taxpayer. Just to add further confusion to the fire, if your earnings are above 100k, then your personal allowance is reduced by £1 for every £2 of your income that is over this limit. In other words, if your income exceeds £125,140, then your personal allowance, the amount of which the income is taxed at 0%, that is removed entirely. This is often referred to as the 60% tax trap, as not only is the income being taxed at 40%, but you are losing some or all of your personal allowance, meaning that the income that was previously tax-free is going to now be subject to income tax. Well, the first biggest mistake I see is when somebody simply just takes their tax-free cash rather lazily from their pension on the basis it's tax-free without paying any regard for considering their tax status and other income. Let's take Sandra as an example. So she's 65, a year away from her state pension, and she's got no other income. She's retired now. She plans on taking 10k from her pension to meet her expenditure before a state pension kicks in and assessing things then. Without much thought, she just takes this from her 25% tax-free cash as she doesn't want to pay tax on it. However, big mistake, as she has no income, she's got her full personal allowance remaining, which, if you remember, means the first £12,570 of her taxable income is taxed at 0%, so tax-free. The opportunity cost of Sandra just using her tax-free cash to fund this 10k withdrawal rather than taking advantage of her personal allowance would be as much as £2,000 if we assume she was a basic rate taxpayer in the future. The second mistake I see, which is not technically to do with pension drawdown withdrawals, relates back to if you're fortunate enough to earn over 100k and how your personal allowance is then reduced by £1 for every £2 of income over this threshold. Not only is this income tax now at 40%, but as the personal allowance is reduced, the effective tax rate is 60% as the personal allowance is withdrawn. So what can you do about this if you are fortunate to be covered by this? Let's take Margaret. She's got a salary of 100k. She's due to get a bonus of £10,000. When you factor in the 60% tax trap that she finds herself in, the net after-tax money she would get on the bonus would actually only be 4k without even considering national insurance tax, which would be a further dent in this net amount that she'd get in her pocket. So what can she do instead? Margaret, if her employer agrees and she's got the annual allowance available to do so, could pay this into her pension as an employer contribution. If she really needed the money, she could withdraw the funds as tax-free cash, and if she did, she would have the full amount of the 10k rather than just the measly 4k on the after-tax basis if she had just simply taken this bonus as income. A further potential cherry on the cake is that by paying the bonus into her pension, her employer will save on the national insurance tax, which could be as much as 13.8% of the bonus, or potentially £1,380. If her employer agrees, of course, she may be able to get the national insurance saving of the employer, so the actual contribution could be £11,380. Not bad at all when you consider the net bonus would be just 4k if she just took it as a simple bonus through PAYE. The final mistake I often see is that people don't realise you can take a combination of both your tax-free cash from your uncrystallised pension and also take taxable income from the crystallised side of the pension. Let's see an example of how that might work. Let's say somebody needs £24,000. So Terence, he can withdraw £12,570 from his crystallised funds, which will be subject to income tax. But, hang on a minute, although these funds will be subject to income tax, as it is up to and within the personal allowance, the income tax will be 0%, and effectively no tax will be due on this side of the withdrawal. Okay, so we know he needs 24k. If we deduct the personal allowance amount, he is still going to need that roughly £11,430. How can he make up the difference tax efficiently? Well, Terence can simultaneously take this shortfall amount, so the £11,430, from his tax-free cash. By doing this, his effective tax rate on the combined withdrawal is going to be a whopping 0%. If drawdown is confusing you, well, watch this video which looks at it in a lot more detail as well as other hugely important factors that you just might not be aware of.